We warned you this moment would come. We said that the instant the banks started losing control of the price, they wouldn't sit quietly and let the market decide the outcome. We told you that when short sellers found themselves staring at extinction, the system itself would step in to rescue them. And we told you that if they couldn't win the game fairly, they would simply rewrite the rules. That moment arrived today, on Tuesday, January 13th, 2026. The rules were changed right in front of everyone. While most people were focused on silver pushing toward the $86 an ounce level, something far more important happened behind the scenes. The Chicago Mercantile Exchange, the CME Group, released an emergency advisory notice, number 26-019. To the average investor, it looked like nothing more than another dull PDF buried in regulatory paperwork. But to anyone who understands how this market really works, it was a direct declaration of war on the silver price. Effective immediately, the CME changed how margin requirements for precious metals are calculated. Instead of a fixed dollar amount, margins are now based on a percentage of the total contract value. For silver, that percentage was set at 9%. In simple terms, with silver trading near $85 an ounce, this single rule change instantly made it far more expensive to hold a silver contract. The margin jumped from roughly $32,500 per contract to more than $38,250. That is nearly a $6,000 increase overnight without warning. This wasn't random, and it certainly wasn't about market stability. It happened because silver went vertical. Yesterday morning, the price gapped from $82 to $85 and surged as high as $86 in early electronic trading. The commercial banks, sitting on massive short positions representing millions of ounces of paper silver, were suddenly staring into insolvency. They needed the buying to stop immediately. The only way to do that was to suck liquidity out of the market by raising margins. The exchange effectively issued an ultimatum to traders using leverage. Send us $6,000 in cash right now, or we liquidate your position for you. This is how forced selling begins. This is how rallies are attacked. It is the same weapon that crushed silver in 2011. It is the same tactic used again in 2020, and for a brief moment this morning, it appeared to work. Look at the 30-minute chart we've been tracking. On the far right side, you can see a series of sharp red candles appearing the exact moment the margin news hit trading terminals. Silver plunged from $86 down to $83.57 in minutes. That move wasn't natural selling pressure. It wasn't fear-driven investors dumping metal. It was algorithms reacting to a rule change and leveraged traders being forcibly liquidated because they could no longer afford the cost of staying in the trade. The mainstream media will use this move to tell a familiar story. They'll claim the rally is finished. They'll say the excitement has faded and the bubble has popped. They want you to look at that red candle and feel fear. They want you to panic and sell your physical silver because the paper price dropped a couple of dollars. But that reaction is exactly what they're hoping for. Before you draw conclusions, you need to look at what happened next. In 2011, margin hikes came one after another, and silver collapsed nearly 30% in a matter of days, falling from $50 to $35. It was brutal. This time, margins were raised by a massive 15% in one shot, and the price fell just $2.50. Now look at the final candle on the chart. Notice the long wick at the bottom. Silver dipped to $83.57 and was immediately bought back up. As this is being said, silver is trading around $83.90. It refused to collapse. It refused to break. That reaction alone may be the most bullish signal we've seen in this entire cycle. The system deployed its strongest weapon. They deliberately made silver more expensive to buy. They tried to break the momentum of the bull market, and all they managed to produce was a brief dip that buyers instantly stepped in to absorb. So why didn't it crash this time? Why is this move different from the past? Because the buyers waiting at $83 aren't using margin. They aren't chart gamblers or leveraged speculators. They are industrial users. They are sovereign funds. They are buyers paying cash. And you cannot margin call a cash buyer. If a company like Samsung needs silver for batteries or manufacturing, they don't care what the CME margin requirement is. They're not buying futures contracts to speculate. They're buying silver to take delivery. When the price dips to $83, these buyers don't panic. They simply buy more. To them, it's a sale. The margin hike only punishes paper longs using leverage. It does absolutely nothing to slow down physical buyers. In fact, it helps them. It shakes out the weak hands and hands them cheaper metal. This is exactly what we said would happen. The market has split in two. The paper market is being controlled through rule changes and margin manipulation. The physical market is being driven by one thing and one thing only: real scarcity. What the banks are trying to do now is put out a forest fire with a water pistol. Yes, they can knock the flames down for a few minutes. Yes, they can create the illusion of control, but the heat underneath is still raging, and it's only getting hotter. And the margin hike wasn't the only sign of panic we saw today. While the exchange was scrambling to change the rules, something far more serious was happening at the government level. As the CME was busy protecting the banks, the United States government was quietly calling for help. Reports confirm that Treasury Secretary Scott Bessent convened an emergency meeting with finance ministers from the G7 nations this morning. Officially, the topic was securing global supply chains, but when a Treasury Secretary calls an urgent meeting about supply chains in the middle of a violent price spike, that language is code. It means something has broken. It means something has run out. If the margin hike was the financial response to the silver crisis, what came out of Washington today was the political response. And for anyone who knows how to read between the lines of diplomatic statements, the political response is far more alarming than the financial one. While the CME was changing the rules of the casino to save the banks, the U.S. Treasury was trying to stabilize the real economy. This was not a routine meeting. Treasury Secretary Scott Bessent reportedly convened an unscheduled urgent call with the finance ministers of the G7, the economic NATO of the Western world. These are the most powerful financial authorities on the planet. They did not gather to discuss climate targets. They did not meet to debate tax policy. According to the official communiqué, they met to discuss how to secure and diversify supply chains for critical minerals. To the untrained ear, that sounds harmless. It sounds like standard bureaucratic language, but timing is everything. Why call this meeting today, on Tuesday, January 13th? They called it because silver touched $86 yesterday. They called it because the Shanghai premium exploded to $8. They called it because over the weekend, global inventories of the most conductive metal on Earth effectively vanished. When a government says it needs to secure a supply chain, it is a polite way of admitting scarcity. It means material is no longer flowing. And when they say they need to diversify that supply chain, it means they are dangerously dependent on people they no longer trust. Look at where silver actually comes from. China is the third largest producer and the dominant refiner. Russia is a major producer. The BRICS nations control a massive share of global supply. The G7 finance ministers looked at the board this morning and saw the reality. They saw Shanghai vacuuming metal out of London and New York. They saw a retail buying wave draining U.S. mints, and they realized something terrifying. The West has no safety net. The United States sold off its strategic silver stockpile decades ago. There is no reserve. There is no buffer. There is only the just-in-time global market. But just-in-time is dead. We are now living in the age of just-in-case. And the United States government has just realized it has no case at all. This meeting also connects directly to what happened on January 3rd in Venezuela. Remember Operation Absolute Resolve? The media told you it was about democracy. We told you it was about oil. It was stage 4 empire behavior, a desperate grab for resources. And now, just 10 days later, we are watching the same panic spread into the metals market. The reality is simple and brutal. An empire cannot fight a modern war, build a green energy grid, and run a digital economy without massive amounts of silver. Modern warfare is electronic. Every Tomahawk missile, every F-35 fighter jet, every drone, every satellite depends on silver, and the world is discovering in real time just how little of it is left. Silver is the best conductor of electricity known to science. You cannot manufacture a modern guidance chip without it. If that supply chain breaks, and dealer delays strongly suggest it already has, the entire military-industrial complex begins to stall. Production lines freeze, systems slow down, and that is why Secretary Bessent is now directly involved. This is no longer about the price of a coin or an investment trade. This has crossed into the realm of national security. What we are watching now is a coordinated system response. First, the CME raises margin requirements to smash the paper price and flush out leveraged speculators. That move is designed to buy time. Then, almost immediately, the Treasury steps in and convenes the G7 to coordinate a strategy to secure physical silver outside the open market. This isn't coincidence. It's choreography. They are attempting to form a buyer cartel working with Europe, Japan, and Canada to lock up mining supply in friendly jurisdictions like Mexico and Peru before China absorbs everything that's left. But here's the problem they're facing. China is already there. The Chinese have been signing long-term offtake agreements for years while the West was distracted by ESG metrics, financial engineering, and paper derivatives. This G7 meeting is not a display of strength. It is an admission of weakness. If they already had the metal, there would be no emergency call. If the market was functioning normally, there would be nothing to secure. The fact that this meeting happened today, directly in response to the silver price spike, confirms everything we've been saying. That $86 price was not a bubble. It was a signal of a deep systemic shortage that has now reached the highest levels of government. And notice how the language has suddenly changed. For decades, silver was dismissed as a shiny relic, a decorative metal, something for jewelry and collectors. Now, almost overnight, it has been reclassified as a critical mineral. That rebranding is deliberate. By labeling silver as critical, governments unlock extraordinary powers. It allows intervention. It opens the door to the Defense Production Act. It gives them justification to prioritize industrial and military use over private ownership. And that sets the stage for what comes next: rationing. If Samsung needs silver for batteries and Raytheon needs silver for missiles, and you want silver to protect your savings, who do you think the government will prioritize? It won't be you. It will be the missiles and the batteries. The G7 meeting marks the first step toward a fully bifurcated market, where access for the public becomes increasingly restricted. They will try to make it harder to buy, premiums will rise, purchase limits will appear, just like what we saw this week with Costco. Hoarders will be blamed, retail buyers will be demonized. Because the truth is simple. They want the metal for themselves, so when you see the paper price drop $2 because of a margin hike, don't get discouraged. Get angry and then get deliberate, because the same institutions smashing the price on your screen are holding emergency meetings behind closed doors, trying to figure out how to get their hands on the physical supply you already own. The CME margin hike was the distraction. The G7 meeting is the reality. They already know the bond market is cracking, and we saw that with the India sale. Now they know the commodity market is breaking too. They are fighting a two-front war against economic gravity. And just like the margin hike failed to break silver below $83.50, this political response will also fail to create new supply. You cannot print a silver mine. You cannot legislate a new deposit into existence. It takes a decade to build a mine from discovery to production. Secretary Bessent can hold as many meetings as he wants. He can issue as many diplomatic statements as he wants. But unless he possesses a way to turn base metals into silver, none of that changes reality. The system response is failing, the paper tools are blunt, the political tools are slow, and the market is moving fast. In the next part of this deep dive, we're going to expose the Shanghai Shield. We'll explain why the arbitrage gap with China is the ultimate defense against Western price manipulation, why the CME could raise margins to 50% and it still wouldn't matter as long as Shanghai is trading at $93. The West is trying to shut the door. The East has already ripped it off the hinges. The G7 is in panic mode. The CME is in panic mode. The only real question left is this: are you in panic mode, or are you prepared? We've now examined how exchange rules are being weaponized. We've broken down the geopolitical panic at the highest levels, and the picture coming into focus is unmistakable. But now we come to the most important question of the day: why didn't it work? In 2011, when the CME hiked margins, silver immediately collapsed. During the 2020 pandemic crash, margin calls made the sell-off even worse, driving silver down to $12. History shows that when the exchange raises the cost of the poker game, the players fold. But today, Tuesday, January 13th, the players did not fold. They stayed in the game. The price dipped to $83.57, and then it bounced. It refused to break. It absorbed the blow like a heavyweight boxer shaking off a haymaker, standing firm and defiant. So why is this time different? What has changed in the structure of the market that allows silver to shrug off a 15% margin hike? The answer lies 7,000 miles away in what we call the Shanghai Shield. While the CME tried to crush the price in New York, the Shanghai Gold Exchange closed its afternoon session with silver fixed at $93.31. Do the math. That's nearly a $10 spread between the paper price in the West and the physical price in the East. In past cycles, this gap didn't exist. In 2011, prices in London, New York, and Shanghai were almost identical. The global market was unified. When New York sold, everyone sold. But now the market has fractured. The West is trading paper while the East is trading real metal. And because the East is willing to pay $93, the Western price literally cannot fall far below $83. Here's how the Shanghai Shield works. If the CME smashes the New York price to $70, does that kill the bull market? No, it accelerates it. Why? Because the $23 arbitrage between New York and Shanghai becomes a risk-free profit. Traders would buy the cheap Comex contracts and ship the metal to Shanghai for $23 an ounce. Every vault in New York would be drained within 48 hours. The banks are trapped, smash the paper price, and they lose physical inventory to China at a discount. Let the price rise, and their short positions blow up. Save the metal or save the dollar. They can't do both, and the numbers confirm it. The inventory data released by the CME today shows a bleeding system. 565,000 ounces withdrawn from Asahi, 617,000 ounces from Brinks, 351,000 ounces from CNT, 791,000 ounces from StoneX. That's over 2.2 million ounces of silver leaving Comex in a single day. The registered category, the silver available for immediate delivery, dropped nearly 400,000 ounces to just 1.23 million ounces. The margin hike didn't stop the bleed. It accelerated it. By smashing the price to $83.50, the CME inadvertently put silver on sale for the very entities draining the vaults. They are feeding the beast while trying to starve it. This is directly connected to the G7 meeting. Secretary Bessent knows Comex is bleeding. He knows metal is flowing from west to east. That's why the government is scrambling to secure supply chains. They are trying to build a fence around a river of capital that refuses to be contained. Money flows where it is treated best. And right now, silver is treated best in Shanghai. The Shanghai Shield is why volatility should not scare you. Every red candle in New York is hitting a floor made of solid concrete, the Chinese bid, unless Shanghai's price collapses, and there is no sign of that given industrial demand. The New York price must hold. In effect, this arbitrage puts a massive put option under the market. Downside is limited, while upside is unlimited because paper shorts are insolvent. We are witnessing the balkanization of the silver price. For a century, New York set the global price and the world followed. Now Shanghai sets the floor, and New York is struggling to keep up. The old rules are gone. The game has changed. The margin hike was a desperate attempt to reassert control. It was the empire's way of reminding the market who was supposed to be in charge, but the market didn't blink. It looked at the $93 price in China and realized the empire has no clothes. Paper tools, margins, spoofing, wash trading only work when the physical market is asleep. But the physical market is wide awake. It is hungry and it is devouring Comex. The 2.2 million ounces that left the vaults today are gone for good. They're not coming back. They will be melted down, turned into solar panels, shipped to Samsung, and absorbed into industrial use. They are gone forever. The system response has now failed on two fronts. The financial weapon, margin hikes, did not crush the price. And the physical weapon, the inventory, continues to drain. So what's left? What can the establishment do next? If they cannot stop the price with margins, and they cannot stop the flow with policy, there is only one option left. They have to close the doors. They have to make it harder for retail buyers to participate. And that is exactly what we are starting to see. In the final part of this deep dive, we will examine the retail lockout. We will look at the new restrictions at Costco, the sellout at the US Mint, and the backwardation in futures contracts. The system is trying to ring-fence the silver market, keeping you out. They want the metal for themselves, and if you do not act now, you may find yourself on the outside watching opportunity slip away. The Shanghai Shield held. The price sits at $83.89. Short sellers remain underwater, and the vaults are 2 million ounces lighter than they were yesterday. The trend is unbroken. We have reached a conclusion. We have dissected the financial war waged by the CME through margin hikes. We have exposed the geopolitical panic behind the G7 emergency meeting. We have analyzed the Shanghai Shield that prevented the price from collapsing. Now we turn to the final piece of the puzzle, the piece that affects you directly. If the establishment cannot crash the price with paper and they cannot secure sufficient supply from the mines, what is their final move? They need to close the gate. They need to stop the public from draining what little inventory remains. The first clear signs of retail rationing are appearing from the largest U.S. retailers. Take Costco, for example. For the past 2 years, Costco has been a major source of silver for Americans, selling tubes of eagles and bars of gold freely. But that has changed. We have confirmed reports that Costco has implemented strict order limits on physical silver sales. They are now capping purchases to 1 transaction per membership with hard limits on units. Why would a retailer limit sales of a product that is flying off the shelves? In capitalism, if people want to buy, you sell. You only restrict purchases if you are terrified of running out. You only ration if you cannot replace the inventory. Costco knows that if unlimited sales continued at these prices, their national stockpile would vanish in hours. This is rationing, soft but real. And it doesn't stop there. The United States Mint, the government entity responsible for supplying constitutional money to the people, is facing the same pressure. The system is trying to control who gets access, slowly shutting the public out, and reserving what remains for industrial and strategic use. The gates are closing. The question now is simple. Are you prepared, or are you watching from the sidelines as the establishment locks you out of one of the most important markets in history? This morning, the 2026 Silver Eagle coins were released, and they were gone almost instantly. The U.S. Mint has announced an immediate 1-month delay on new orders, back-ordered. Think about that. The United States government, with all its resources and vaults, cannot stamp a 1-ounce coin fast enough to meet demand. This is a failure of the sovereign supply chain. It is proof that the just-in-case panic has overwhelmed federal production capacity. But perhaps the most technical and most telling signal is unfolding in the futures market itself. It is a phenomenon called backwardation, and more specifically, backward rolling. Normally, when a futures contract expires, traders roll their position forward. They sell the expiring month and buy the next one. Routine, predictable. But the CME open interest data shows something extraordinary. Traders are rolling backward. They are fighting to stay in the delivery month. We saw 369 delivery notices issued for January, yet open interest fell by only 233 contracts. That means for every person trying to exit, there is another fighting to get into the immediate delivery window. They are snapping up January contracts because they don't trust that the metal will be available in March. This is the textbook definition of a squeeze. Shorts are trapped, longs are demanding delivery, and the exchange is trying to separate them with margin hikes, but it isn't working. So what is the verdict on this historic day? The system response has failed. The CME fired its 15% margin bazooka, and silver is still trading near $84. The Treasury convened the G7, essentially admitting vulnerability. Retailers have begun rationing. The system is blinking red. They tried to break the market's psychology today. They wanted you to see that margin hike and panic sell. They wanted that red candle on the chart to stop momentum. But it didn't work. The Shanghai shield held. Physical buyers stood firm. This $83.90 price is not just a number. It is a victory flag. It marks the moment the market realized the banks are powerless against a real physical shortage. So what should you do? If you are holding physical silver, do not let them scare you out of it. A $2 dip caused by a rule change is nothing. That metal in your hand is your protection against the currency and economic crisis the G7 is scrambling to manage. And if you are looking to buy, understand this. The window is closing, Costco is rationing, the US Mint is delayed, premiums are rising, the easy silver is gone. Now we are fighting for the scraps. The path to $100 is now clear. Resistance at $80 is gone. Resistance at $85 was tested and held. The next major barrier is the Shanghai price at $93. That gap will close. It's a matter of physics. The empire struck back today, and the empire missed.